today is Ask Me Anything Friday. I am sure that we're going to be flooded with questions about Plan A, Plan M, Plan ETF, Plan Sit and Cash and Don't F Up. Justifiably so. So I'm here to answer all of those for you. And in fact, I am planning on instituting Plan ETF today. Now, does that mean I'm going to win? No, we need to be 100% transparent here. Is that Plan Sit and Cash and Don't F Up is the only foolproof, or next to, I guess there's always a chance, only next to foolproof plan. Okay. And that's pretty easy. You're just buying SGov, which goes up and then goes down and goes up and goes down. And we have a plan to work around that, right? I've shown you that yesterday. Plan ETF still has the possibility to lose. I need you to understand that. Plan ETF is the defensive plan, just like Sit and Cash and Don't F Up is a defensive plan when we don't have anything to trade for Plan A or Plan M. Okay, so I'm really stoked about that. I'm excited to start using Plan ETF like today, super duper today. So man, I am so stoked that I can be with you, right? And man, I got to tell you, the way that we have this set up, where you basically have 365 days of trading plan, how great is this? What a huge improvement. How great is this, right? But it's great to see everybody today. Of course, put your questions in the chat and we will get ready to do this. Okay, so let's begin right here with what is a leveraged ETF? Don't worry about the LOL on that one, Charlotte. That's a great question. So a leveraged ETF is a ETF that tracks a certain underlying. So for example, TQQQ, which is what we're going to be using in Plan ETF, tracks the QQQs, the NASDAQ ETF. Now, TQQQ is a triple leveraged ETF. So every day that the NASDAQ goes up by 1%, TQQQ would go up by 3%. Conversely, every day that QQQ goes down by 1%, TQQQ would go down by 3%. Now, if you remember math, right, we've talked about the math all the time. Losses hurt you more than winners do percentage-wise. And a 50% loss, right, a stock going from $100 to $50 requires a 100% gain going from 50 to 100 to get back to break even. This is what breaks down leveraged ETFs, because over time, pretty much all leveraged ETFs have an asymptotic slope. An asymptotic slope is one that goes towards zero and then basically flattens out and never crosses zero. Now, why would we want to trade that? The reason that we do want to trade this is Scott has found unbelievable data to support when these buy signals come in place, when the heat map is under 70, even with the there's a name for it. I forget what that name is. But even when that is happening, it is still unbelievably more profitable than sitting in cash, obviously. But like literally triple, which as you would expect, what the Qs are returning. So it kind of offsets that issue. Now, Plan ETF is not to use options. Plan ETF does not involve options. Could you buy long calls on TQQQ? Yeah, for sure. Could you buy long calls on QQQ? Yeah, for sure. Could you buy leaps on those? Yeah, for sure. You do you. But for me, this is not an offensive play. This is a defensive play. Because it is a defensive play, I don't want to be going deep in the money options here. I just want to buy the shares. But it is a brilliant question, Charlotte, and thank you so much for starting off like that. Nate asks about merch. Is it possible to get an outlier hat in the colors and style of that shirt? Highly unlikely. Highly unlikely. Anthony has a great question about hats as well. Where do you get an awesome hat like that? Well, if you're watching the replay, you're going to see links down below. You can click one of those links and grab it. Or if you're watching live, just go over here, outlier-shop.fourthwall.com. We have everything priced at the absolute lowest we possibly can. It is cost plus 20%. They wouldn't let us do cost plus 10%, but here's the great part. If you put in the code outlier at checkout, it will lower your price by 10%, making your total net cost plus 8%. Our goal is not to make money on merch. Our goal is to sell you the merch as low as price as possible. That way you go out and wear it and you buy more of it and have tons of fun with it. And of course, advertise like you would for Nike, but for Outlier. So anyway, Our goal is not to make money on merch. Our goal is to make Masters of the Universe money. That's the plan here. Julian asks, what have been the back-tested return on capital results for Plan ETF? Okay, I have it literally right in front of me. I don't know how much of this I can share. Mahesh has said we can't just publicly show all the data, but here's what I'm going to do. I'm going to hide everything except the first and last rows. Then I'm going to pull this over here. Then I'm going to screen share. So Mahesh is our CEO, for those who don't know. So the Qs are the blue line. Buy and hold. TQQQ is TQQQ. The red line is TQQQ as Plan ETF. As Plan ETF. Yeah, it's crazy. And then I don't know if you can read these numbers very well, but the expectancy is 7.5% versus 2.5%. And this is one of the reasons I want to show this as well, is that some of these are as long as 105 days, like unbelievably super duper long holding Plan ETF, which is one of the reasons I don't want to use options, is because that theta is going to get chewed up, right? I mean, even if you buy a 365-day leap, first you're going to pay a shitload for it. You're going to pay a metric butt ton for that option. And then that theta is going to just eat away at you day after day after day. And even if it's a year out in time, if you're letting a third of a year go by holding that, it's going to really start to make an impact. It really will. Who's winning the MLB AL West division? I don't know. The Dallas Cowboys? I don't watch sports, bro. I pay attention to more better things in my life. Like, how do I make more money? That doesn't sound offensive. Why not use triple Q? Okay, great question. Great question. Reason being is in this expectancy right here, triple Q shares on their own 2.59%, TQQQ 7.5%. Following the exact buy and sell signals. Exact same, absolutely no difference. But as shares versus as options. Great questions. Which is the most risky yet come with the best profits? Well, let's break this down. So Plan Sit and Cash and Don't F Up is obviously the least risky, right? We're just buying bonds at that point. Plan ETF has addition. In fact, let's rank. Let's rank. Least risky, right? Let's do like D tier risky is Plan Sit and Cash and Don't F Up. C tier risky would be Plan ETF, right? And part of the plan for ETF is not using options for the impact of, we're not trying to capture outsized gains here. We're just trying to take a little bit more money out of the market than we would in Plan Sit and Cash and Don't F Up, right? There is market risk associated with this. Not as much by buying the shares versus buying the options, but that puts it into C tier. What goes into B tier? Absolutely, without a doubt. Plan M goes into B tier as far as risk goes. It pays so much more than Plan A. It pays 250% more expectancy than Plan A. And because of that, that means it has less risk. The win rate is like 10 percentage points higher. And it's probably going to be even higher once we start rolling the options as well. And then Plan A certainly falls into most risky, but also Plan A is amazing. Plan A, we worked for weeks making that thing as beautiful and smooth as possible. But when we applied the same entry criteria to Plan M, applied the same entry criteria on active signals to the swing signals, it was like a totally different world. So that's the great part about this. We now have two different types of aggressive offensive signals, Plan A and Plan M. You can use either one. I'm going to focus on anytime there is a Plan M signal, I'm going to take it. And those Plan M signals can last up to 5 days after the signal date that I'm going to take it. And then if there's nothing that I can do with those and I still have extra cash, that's when I'll move to Plan A. And then there's going to be a point in time where neither Plan A nor Plan M have any setups, and it might be a while, like we're sitting in right now, before any new setups come. So that's when we move to Plan ETF. And then there's times where we get an exit signal, Plan ETF. We don't have anything for Plan A or M. So then Plan Sit and Cash and Don't F Up comes into place. This is a whole cohesive 365-day plan here, which I'm very, very excited about. Let's see. Falcon Film and Media. You know what? Sometimes you got to take time off, right? Mark has some family priorities that he is taking care of right now as well. Is there going to be a catch-up video? Probably, but also every day is a catch-up video if you want to think about it like that. Is there a single place for everything? So right now, in our Discord, we have what's called the VIP Investors Toolkit. Deep Thought is kind of our Discord guru, and he's handling all that. J Mac from the Discord has offered to take my plans and format them in a beautiful way, which I'm very excited about. I'll be shooting the PowerPoint to him right after this video. And that's going to make things look amazing because I can come up with great plans, and I love to plan things out, right? You've got to plan in losses. You've got to plan in position sizing. You got to plan in entries. You got to plan in exits. You got to plan everything as a whole cohesive factor here. But I'm not great at designing how that looks. So JMac, thankfully, has allowed us to use his expertise. Anthony asks, is SGov up a little higher today? I'm seeing a slight bump in daily interest. I don't know. Let's take a look over here. SGov. Let's go look at SGov. 100.58. Hang on, let me add extended hours. You know, I have a complaint on TradingView, and that's when I add in extended hours, I then have to go and move this around. I don't know, it might be. It might be. I mean, it's not like it moves all that much already, so it could be. Rude's flashed up Michael Ross, so let's go to Michael Ross over here. Michael Ross, the boss, not to get ahead, but if we lose bullish and go bearish, would you use Plan A or M for a put play? I assume ETFs would be off the table. So in that case, we would be sitting in Plan Sit and Cash and Don't F Up. OVTLYR is built as a long-only platform. Bearish signals are coming. Bearish signals are in R&D. And I'm not going to be taking any inverse signals, if you want to think about it that way. I used to, but I don't plan to, because we will be having those signals come through. And probably by the time Scott gets out of uni, as he says, and we hire him full time next year, we'll have that bearish plan put in place. New position sizing has not come out yet, so I worked on it yesterday, and I got really frustrated by it yesterday. Reason being is on Plan A, position sizing made sense. It's whichever has the greater of risk between the half ATR or the distance in current price to the 10 EMA. And that makes a lot of sense because 10 EMA is our exit. I applied the same logic to Plan M, which is a 2 ATR exit. And I'm telling you, like, the position sizes on there were babies. Like, when we're so small that it's like not even worth trading. So we've been working really hard with Elliot, and so we're putting him into like one-on-one with one of the high school players, and he's really come a long way. But last night, while I was at football practice watching Elliot, because I'm a sports dad now, I just sit there and, you know, talk about the other sports dads. I was texting back and forth with Scott saying these position sizes are so small, like legitimately one lots and some stuff. And I'm like, I'm not trading this with one contract. It's not going to happen. So we were going back and forth, and he sent me some data, which I plan to work on today. I was texting the Alpha group earlier that this is one of the things I'm working on today. And rather than building the 1/4 loss to the 2 ATR, one of the things I was considering is building the full, 5%, if that's what your risk is, to the 2 ATR. But I'm not condoning that just yet. I really want to run the data and look at this. One of the things that he sent over, which was so cool, was he figured out how much ATR moved down and how much ATR moved up were the max values throughout each one of the trades. And it's like, wait a minute, that's so cool. If you can see that there's a pullback of, for example, 0.8 ATR, and then the overall trade ends up being up 3 ATR, how cool is that, right? So then you're not scared when you see pullbacks, right? Oh, this is an average pullback within the trade that I'm taking. And then I was like, Scott, what if we figured out how many days after the signal that this pullback comes, and then we get in after that pullback comes? I don't know. I think there are some really, really cool enhancements that we can make based on that data. So I'm very, very excited. But to answer to give you a long answer to a short question, it is not out yet. And that's because I don't like how small Plan M has us. And reason being is, I mean, if you put on 20 trades, you might legitimately be at like 40, 60% of your portfolio with 20 trades. And that's too small. It really is far too small. You really want to be full port, 10 to 12 trades, maybe 15 at the most, full port at that point. Now, some of you may be thinking, well, that's not very good diversification. No, it's not. If you want diversification, just buy the SPY and go away, right? We don't want diversification. Stanley Druckenmiller, say what you want about George Soros, but George Soros made ungodly amounts of money by being a trader, right? Political beliefs aside, whatever. He made so much money trading with Stanley Druckenmiller. Stanley Druckenmiller, one of his quotes is saying, put all of your eggs in one basket and watch that basket like a hawk, right? I believe in that as well. Mark Minervini talks about how you need to make sure that you are concentrated in stocks that are moving, right? Diversification is what diversification is. I do not want a portfolio of 50 stocks to hit 100%. To some people, that's exciting to them. They want the action. I don't. That's work. That's not lifestyle design. That's lifestyle chaos. Could you imagine trying to keep up with 50 positions? Absolutely not. But could you keep up with 10 to 15? Yeah, it would definitely be worth work, but it wouldn't be overwhelming amounts of work. So I'm going to be working on that today. We still want to be focusing in on risk because the stops are wider on Plan M, but the way that it's set up right now, it's just too wide. The TQQQs matter if the market signal is red. So all we're looking at on the TQQQs is what does the Qs say? And it's actually really, really simple. In fact, let me pull up the plan real quick. Now, this is going to look different later on after JMac makes it look beautiful. But the Plan ETF is we're only focusing in on the Qs. What is happening with the Qs? Is the Q heat map under 70? Doesn't matter if it's going up or down. And does the Q have a buy signal? But in order to get the leverage, using TQQQ as our vehicle. What about stacking for smaller lots as the trend moves? I have found and I have seen data that shows that lump sum investing, which is what I like to do now, is better because it gives you a higher return than trying to stack into a trade. Now, I've tried to do that in the past, and I got burned hard multiple times. I like to think of it this way. Let's look at a chart. I'll try and demonstrate. Let's look at AMD. Let's look at AMD. All right. Let's say that I bought AMD right here. Okay. Just for example's sake, let's say that I bought AMD right here. Come on. There. I have to click that 4 times. My first lot goes out. Okay. And it's making money all the way up. My second lot, I might have bought right here, and it's making money all the way up. My third lot, I'm buying right here, and it's making money all the way up. My fourth lot, I buy it right here, right? The problem, and what I ran into personally, and I think is why it proves out that the lump sum investing is a greater overall return than pyramiding in is that once you have, let's say, for example, 4 trains that have left the station, you now have 4 trains working against you. You now have 4 different trains coming right back at you all at once versus just having one train go out and one train come back. You've now levered in, if you want to think about it, you've now levered in. So when it does pull back, it pulls back 4 times as hard as it would had you just had the full size originally. And that is just my guess as to why lump sum investing works better than pyramiding in, but that is exactly. Orlando. Hey, check this out. Orlando, that's a great question. It's such a great question that No Show Joe decided to make a little ticker on this one. So there you go. I'm just going to roll it up on the screen and you guys can read that at your leisure. No Show Joe, totally his new name. Stefan says, why not start with plan A? And if it drops below the plan A exit point, sell down the position size and go with plan M on it. I don't know, man. That's just not for me. It feels very complicated. And granted, Stefan, by all means, if that's what you want to do and you build your trading plan for that, go for it. And you guys have understood, and I preach this for a long time. And this is every time that people ask questions like that. And I'm not picking on you particularly, Stefan. I am a huge advocate of personal accountability, personal agency. And this is something that I worked with a trading psychologist. It's like, listen, take accountability. Not you, Stefan, in general. Take accountability, create your own plans, come up with your own ideas. All right. When you do that, you become so much better at your plan, your ideas. Okay. And you'll never hear me say, this is what it must be, set in stone permanently forever. No, I'm sharing with you my plan. You can choose to use it or not, right? Of course. Lots of people in Discord. I think David was saying, I forget where he said it, but David was saying it's a great market. He's up 20% in the last couple of weeks. Dude, that's awesome, right? I'm not, and that's okay. I'm just following my I'm just following my plan. Just following my plan. Is the screener impacted by the active or swing signals? Yes. When you, and now I believe this, I checked with Mahesh. One thing that I asked him is if we could have the screener have a clicker, basically, that says active or swing signals right here. Because I believe when you make the change on your individual stock, so let me show you what I mean. Like, let's say we go to Qs. I'm gonna turn that off now, so less distracting. When you change this up here from active to swing, it's supposed to be a global change. And so that should be reflective in the screener. But I cannot confirm that at the moment. And for those who are asking, on all ETFs, the active and swing signals are identical. They are one and the same. There are not any differences. Let's go back to the comments here. By the way, I'm so stoked to have you guys here, and thank you for all the questions. Why stock only category in investment championship shows better returns than the ones with futures or options? I don't know. That's a great question. I've had that thought too. So there are different categories in the US investing championship. There's like stock only over $1 million, stock only under $1 million. There's options and enhanced growth, meaning options or futures over $1 million, options and enhanced growth under $1 million. I don't honestly know why the ones that are stock only can have such crazy outsized returns in comparison to the options one. I don't know, but it's really impressive when they do that. Really impressive when they do that. Sylvia, when there's an abundance of signals coming through, your plan is to take the top 10 by outlier return. Correct. Was top in by volume tested. Trading options require high open interest and low spread. Yes. So that's why I said top 10, because I know that of 10, there's probably going to be a handful that come through, right? There are days in the back testing that were, I think one of them had 105 signals come in a single day. Sylvia, you and I, even combined in our account size, wouldn't be able to take all 105 signals. Just not going to happen. So how do we rank those? And I would say that if there's any luck involved, it's that. Just the luck of the draw of which ones fall in the top 10 by historical return, and which ones have liquidity enough to get in. So to that point, you could rank it by any way. You could rank it alphabetically. You could rank it by signal return. You could rank it by your favorite to least favorite company. Doesn't really matter. The point is that if you are capital restricted, like we all are, then you have to find some way of ranking them and taking those stocks in that order. I have found that to be the most effective. When are you going to get some new songs? Okay, Rick, great question, because Rick has made some new songs. We had, as you guys have noticed, there was a change in the OVTLYR servers. That was a big deadline that we were working on, and that deadline has now passed. The integration is done. So hopefully, Rick, by next week, we can start having more of those songs ready. Dude, you're such a rock star, like legitimately, actually a rock star. And I appreciate that, my friend. Steve, will you be able to help the UK team with Plan ETF? We can't trade TQQQ. Scott is based in the UK, and he was the first one to point this out. He's like, man, I'd love to trade Plan ETF using TQQQ, but I can't. So that is a Scott question. I'm sure ChatGPT could also answer that question real quick. So yeah. Let me scroll. By the way, it is so awesome that all of you guys are here. When will the OVTLYR fund roll out for me? It's going to be years from now. And part of what we're doing by having the OVTLYR fund that we're going to make as transparent as humanly possible is to build that track record. Actually, funny story. One of the football dads that I hang out with is actually a securities lawyer. So we've had this discussion a few times, and he's like, yeah, man, one of the big things is that you need to have a track record to show to investors. And then you need to let them know that the track record that you have created originally, right, is not the same account that you're going to be trading with once the new fund goes into place. I was like, that makes total sense. How many stocks to focus is too much? That's a great question, Sue, and that's a really a personal choice. I personally feel when I get over 8 that it becomes very daunting. That it's like, oh, okay, let me go through, let me check on this one. Okay, let me make sure I'm good to go, right? And I've mentioned this story several times, but there was a guy years ago who sent me a screenshot of his portfolio. It was a $3 million portfolio, and I swear that dude had 96 stocks. And my first statement was, there's no way you can keep up with all this. You're just buying stocks like books on my shelf, right? Oh, there's the stock, let me buy it. Oh, there's the stock, let me buy it. You have no plan here. You have no entry plan. You have no exit plan. You're just like, wow, that's a cool looking stock. I'm going to buy that. That's what leads to billionaires becoming millionaires in the market, is because they have more money than they know what to do with. And so rather than having a plan, they just feel like, I'm just going to buy one of everything. Why not? Or if you're going to do that, just buy the market. Just buy the SPY. So are we using the buy and sell signals on Q to enter exit triple Q? Yes. And I love the Batman taking a little bath thing art. That's so funny. It's so cute. I love it so much. Oh man, I found a new thing on eBay yesterday. I'm so stoked about it. It's a Scrooge McDuck bank with a clock built into it. That'll be on the shelf here whenever that arrives. But man, my first passion in life is clocks. My parents had this old timey clock, which I actually have right over there. It needs some work on it. That was gear driven. So my mom, I think this clock's probably 150 years old. My mom would go over there and she'd grind the gears and stuff, right? And I remember that clock being outside my bedroom every night and just hearing that tick, 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 tick. And then all night, every night, all day, every day, it would ring on the hour and every half hour. And I think that really helped me develop my passion for clocks. And then Scrooge McDuck, I like to say, is my spirit animal. So yesterday when I found that on eBay, a Scrooge McDuck bank with a clock built into it, I'm like, oh my God, I have to have this right now. So I'm very excited about that. That's going to go on the shelf soon. Would you buy the dip on Plan M? So Plan M signals, let's talk about that real quick, because it's very possible, super duper possible to buy the dip in Plan M. Let's talk about that. Plan M, all of these criterias must be in place, which is the exact same criterias as Plan A, with the exception of Plan A is active signals, Plan M is swing signals, and it includes all of Outlier 9. Now, can you buy the dip? The way that this is set up and the way that we found backtesting wise that works is you can take a signal up to 5 days, 5 trading days after the buy signal comes through. So for example, if the buy signal comes through on Monday, you could still take it on Friday, but all of this must still be true on Friday. It can be true on Monday, not true Monday, not true Tuesday, Wednesday, Thursday. But if it then comes to the case that all of this is true again on Friday, you can then take the signals from Monday. Isn't that cool? I'm super stoked about that. It allows us to have a lot more opportunities than we ever did before. Second chance signals, if you want to think about it like that. I will never trade the zebra strategy. This is a options selling strategy, and I'm not even going to look at it, Mr. Launchpad McQuack, and I wouldn't encourage you to do so either. Because what does it do? It breaks the golden rule of leverage. It breaks the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. And the zebra options trading strategy is exactly that, precisely to the T. Mikey Mike asks, what are leaps? Leaps are long. I forget what the leap word stands for. It doesn't matter. All that matters is that they're long duration options, greater than 90 days. People like to use those instead of buying stock, right? Because you get the leverage with the options. You get the delta moves with the options. But they get really, really, as you would expect, Mike, they get really, really, really expensive the further out you go in time and the deeper in the money you go. Where I don't know if it makes sense. In fact, let's look at one together, Mike. Mikey Mike, the market maker. Everybody say hi to Mike, not Mark. Everybody say hi to Mike in the chat. Hi, Mike. I love Mike. Mike's one of our university graduates. So let's we'll go to AMD. I like to pick on AMD. So let's say that we were looking at the October 17th, which is 28 days out. And let's say we went with the 83 delta, would cost us $20.05. All right, so I'm going to type this on the calculator so I don't forget. 20.05. Okay. Now let's go to 90 days. There's 90 days right there. And we went with the 83 delta. That would cost us $37. Okay. So we went from 20.05 to $37. Now let's go to 180 days. So remember, 20.05, 37. And for the 83 delta here, we're talking about $45 a share. Now, why do I care about that? The 28-day option, 20.05 divided by 157 is 12%. So you can control the shares for roughly 12% of the cost of the share outright. So think of it, for example, you're getting an 88% discount on the shares. If you go 90 days out and it's $37, where'd it go? And it's $37, 37 divided by 157, it's 23%. So you're still getting a nice, beautiful discount. But of course, it costs more out of your account. But you're getting a 77% discount versus a 88% discount, right? Think of this in leverage terms. I'm trying to relay it in discount as to why I like to think of it this way. So for 23% of the cost of the stock, we can have an equivalent move of 84 shares. Pretty cool, right? Then let's go to 180 days here. And that would be $45. So let's round it to 46. Divided by 158 gets you at 29%, right? So we went from 12% of the cost of the stock to 23% of the cost of the stock to 29% of the cost of the stock. So in a nutshell, you're losing your leverage. You're losing your leverage with leaps, and it's costing significantly more out of your account, right? This one costs $20 on the first one. At 28 days, this one costs $46, nearly 2 times over, let's call it 2.5 times, give or take 2.5 times as much just to go out further in duration. So can people do it? Yeah. Do people do it? Tons of people do it. Just not for me. Just not for me. Justin D, in the enhanced growth division, can you choose to trade stock and options, or do you have to trade? I believe the rules are options and enhanced growth means you can do anything you want. Basically, you can do futures, you can do options, you can do stock. It doesn't matter. They're widening out the ability to trade whatever you want in that case. Good question though. What are my thoughts on quad witching today? So quad witching is when the month end is closing, the quarter end is closing, the index options are closing, and something else is closing. I forget what it is. Maybe it's futures options. I think it is futures options are closing today. I don't pay attention. It's the truth. I just don't pay attention. I don't care. I'm just going to follow my plan, and I would encourage you to do the same too. And hear me out. If quad witching is part of your plan, you need to make sure you're focusing on it. It's just not for me. Will market breadth adjust during record highs, or will it only expand after a pullback? Let me see if I can understand that question, Don. Will market breadth adjust during record highs, or will it only expand after a pullback? So market breadth is measuring how many buys or sells we have in the platform. So let's take a look at that. So if we're looking at it today, we can see over here on the left-hand side, several sectors are showing bullish. However, the full stocks is, oh, you can't see that. I'm sorry. The full stocks is still showing bearish. And what this is measuring is how many buy or sell signals we have on full stocks. And then the 10 EMA is the moving average of how many buy or sell signals we have for that. By the way, I created this indicator. I'm super proud of it. It's amazing. And it is such a cool leading indicator. Like legitimately, go plot this on a chart and you'll see how it leads what the market's doing. Now, you'll see right here that the market's been going super strong where breadth has pulled back, right? And that disconnect right there is real, right? What that tells me is fewer and fewer stocks are pushing the market higher and higher. Now, remember, the market, the S&P 500, is a market cap weighted index. What does that mean? That means the big Mag 7 stocks. In fact, let's go to this map so we can all be on the right page here. It means these big stocks are really the ones that are holding up the market. The rest of the market is getting weaker and weaker. Where's my tab? There. The rest of the market's getting weaker and weaker. It may have bottomed. I'm just saying right now, it may have bottomed. But if we go to like the 1 month performance, yeah, I mean, look overall at the market. We're seeing dark reds and dark greens, which means not a whole lot's going on. But the concentration has been in Google, has been in Broadcom, has been in Apple, has been in Tesla. These big names, like Tesla up 31% in a month, Google up 26% in a month. And then we can compare anything else. The best winners out there, United Healthcare up 12%, Eli Lilly up 8%, JP Morgan up 6%, right? And then you've got entire whole sectors that are just like getting totally monkey hammered. Okay. So what this tells me is that less and less stocks are pushing up the market higher and higher. That is a dangerous place to be. That is a weak trend. Meaning, it doesn't take a genius to figure out if only a handful of stocks are holding up the market. If one of those stocks has a bad day, has a bad week, the market is going to really reel from it. The market is going to be hurting bigly and badly. So, is what is. Just follow your plan. Just always follow your plan. And market breadth is not factored into Plan ETF. And it's pretty cool because Plan ETF is just simple, 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 simple. And that is by design. Ozzy Ian has a brilliant question. Where can I find OVTLYR and how much does it cost? Well, Ozzy Ian, let me help you out with that. It's you can head over to outlier.com, pick up the annual pass for just 82 cents a day. Can you believe that? Just 82 itty bitty baby cents a day. And it allows you to get into the platform, into our Discord, and into the invitation only live streams where we'll be putting on trades and winning the US Investing Championships in 2026. I personally think it's a great deal. I think you might as well. Thank you, Ozzy Ian, for that layup. I love you, man. Steve, will utilities with utilities and staples being considered defensive, would trading them still fit in Plan M and Plan A, even if it's just those that are bullish? Absolutely, 100% absolutely. So to Steve's point, when you see the utility sector or the staple sector showing a lot of strength, right? When you, in fact, let's go to those real quick in the map. I'd like to look at that with you, Steve, my friend. Here's the map. Where's the utility sector? Over here, right? The utility sector is just like getting killed. Look at all those percentages, right? When the utility sector is looking really strong, that is a bad sign for the market. That means people are going into safety. That would be a flight to safety stock. Same with staples. Where's staples on here? Consumer defensive. So P&G, let's see, tobacco, discount stores, when those start doing really well, that is not a good sign for the market. That's people being defensive. Like Dollar General. Do you really think that people, I don't know, can I swap over? Here we go. Do you really think that when the market's great, people are flooding into Dollar General? No, of course not. Think about it from a story perspective, right? When does Dollar General get the most traffic? When people feel really poor. I hate to say it, but that's the truth, right? Dollar General caters to a low income consumer. So therefore, if the market's performing poorly, if people are feeling poor, they go into lower cost stores. Therefore, that should boost up the stock price of those stores. That is exactly how investors think. That's why that is the place to go for a flight to safety. If the economy is looking bad, people are going to start shopping at Dollar General, which is going to boost Dollar General's price. So people are moving out of Broadcom, out of Nvidia, out of Amazon, out of Tesla into Dollar General. So if you think about it that way, that's why utilities, which nobody's going to make sure that their electricity gets turned off. Nobody's going to make sure that their gas or other utilities get turned off. That's why those stocks do well while the market starts to look worse. Pretty cool, right? Now we can understand the macro picture of that. Will adding more stocks to the platform affect the market breadth? You better daggone believe it will. So we cover 2,600 stocks right now in the Outlier platform. By October 9th or 10th, we're going to have a pretty sizable upgrade roll through. In that upgrade is the market breadth looking like Vaclav's bookmarklet, which he just sent a new upgrade today. Bro can't even sleep. He's always making upgrades. Vaclav, everybody pay respects to Vaclav in the chat. Vaclav. I am so stoked and impressed by what Vaclav is doing. Like almost within hours of announcing what these plans were, he had updated his bookmarklet to make it work. I was like, dude, come on. How can you be such a genius? Okay. So anyway, we're upgrading our market breadth profile inside of Outlier to match what Vaclav has put together. I don't know if it's going to look exactly like it. I doubt it, but in a very similar vein. And market breadth will be impacted by the 2,000-ish stocks. That's right. I said 2,000 more stocks with buy and sell signals, with the heat maps and everything you'd want by October 9th or 10th. So if you don't see the stock that you like now, there's a high likelihood that you're going to see it here in just a couple weeks. I am so stoked about that. And we will actually have all NASDAQ listed stocks and all New York Stock Exchange stocks listed in the platform. They won't all have, and there's going to be 5,000 to 6,000 of those more, 5,000 to 6,000 more. They won't all have the buy and sell signals. They'll have some sort of disclaimer on there that says, we're still collecting data on the stock, something like that. I'm not making it. We're still collecting data on the stock. Once we have enough data to generate the buy and sell signals, then they will populate. But basically you can log in Outlier and see every stock you want to see. So I'm super stoked about that. It's going to be awesome. Going to be so stinking awesome. 2 more questions, then we're out of here. Ravi, I know Heatmap and Fear and Greed are different. Actually, they're one and the same. Let's talk about that. So let's go to let me pick a random stock because I'm the most random guy on the internet. Let me think about this for a moment. What? Starbucks. I was just thinking about S-Bucks. All right, let's go to Starbucks. So let's talk about this. So the heat map is both of these items. They're both measuring fear and greed. What this one is measuring down here is the discretionary sector's average fear and greed score, which is actually shown right here. If you ever want to look over here, this shows you how many stocks are showing fear and how many stocks are showing greed. Fear and greed. And then the height of the bar shows you how fearful or greedy they are on that day. Okay. Now this is this shown in a timeline fashion. So it makes it much easier to read. So this is the average fear and greed score for all the stocks in that sector. Now in the discretionary sector, there's 204 plus 54. So there's 258 stocks in this sector. The average fear and greed score today in that sector is 63.36. How cool is that? Right. But Starbucks, everything looks bad. They found out about the HEB Texas pecan blend, which I went to HEB yesterday to get a fresh new two-pound pack of ground for me. I like my grounds like as fine as dust as possible. So on the little grinder wheel, it goes from coarse to Turkish blend. Chris is at Turkish blend all day, every day. I like my coffee ground as fine of dust as possible. So I don't buy Starbucks anymore. I buy the HEB Texas pecan blend. And Starbucks found out about that, and now they're getting absolutely monkey hammered, right? What about Bros? What about Dutch Bros? As you know, I'm a coffee princess, and when I do get coffee out, I go to Dutch Bros. Dutch Bros has also found out about the HEB blend. They're looking terrible. So we can see the discretionary average right here, but then we can also look at the Dutch Bros fear and greed, right? Dutch Bros fear and greed is really cool right here, and it definitely falls into what Chris talks about as far as snapbacks, right? Dutch Bros fear and greed got down as low as 17, snap right back, right? And then it came back up. Now Dutch Bros fear and greed is going down once again. It's at 24. Could it have a snapback? It totally could. Either way, this is the fear and greed heat map for the stock. This is the fear and greed heat map for the sector. So Ravi, that's a great question. Thank you for giving me a moment to explain that. I love you, man. Glad you're here. I know you're a man because 92% of our audience is men. So the unlikelihood of you being a woman is pretty low. All right, last question of the day. Lifestyle balance. As you know, that is one of my big things in life. I got that from the 4-hour work week. Lifestyle design is something that everybody should strive for. And that's why one of the reasons why I don't sit in front of my screens all day, right? Well, I do because I'm doing like work for OVTLYR, but like if you are at a point in your life where you sit in front of your screen trading, that is not a lifestyle that I want. I've tried it in the past. I've made some money. I've lost some money, but I've lost years off my life and hair off the top of my head. And I decided this wasn't for me. So my style of trading is swing trading. You know, it can be as quick as one day. If it's a loser, I need to get out, or it could be as long as 2 to 3 weeks, right? Depending on how great the signal is and how long that it lasts before I get an exit signal. So on Plan M, your option is expiring soon, and the trade is not profitable, but it has not hit any sell signals. Are you closing or rolling? Okay, great question. I actually have a slide exactly for this. So all of Plan M, all of Plan A, all of Plan Sit and Cash and Don't F Up, and all of Plan ETF, I've not changed anything as far as the option plans. The option plans are going to remain exactly the same. So my slide for that is this. Once you get to 1 week before expiration, so that would be today if you have expirations of September 26th. So imagine I'm in AMD long calls, and today is September 19th. And by the end of today, I'll have either done one of two things. I'll have closed it or rolled it. I will not hold it. Will not, absolutely under no circumstance will I hold it for less than a week. Not a chance. You couldn't get me to do that with your money. So 1 week before expiration, ask yourself these questions. Number one, are you already profitable? If you've been in this for a few days and it still hasn't worked out, the likelihood of it working out later on just gets lower and lower and lower by the day. So if it's not already profitable, I would close it now, personally. If you are profitable, can you roll out and up? This is a key term here, out and up for a credit. So what does that look like? Let's say that you were long the 145s, okay? And you're like, man, I've made some money, but I haven't got any exit signals yet. What do I do? So in this case, let me start over here. You would take the 145s and you would sell to close. So you would actually click the bid button here, which would get you to sell. You would go out at least a week, maybe longer. You will not be able to get this same strike for less money to take in a credit. So for example, right here, it's let's round it and say you'd make 1340 when you sell it. To get the same 145 strike would cost you 1430. That would be a debit of 80 cents. Oh, click the wrong button right there. That would be a debit of 80 cents, right? We don't want that. That actually adds risk to your trade. It costs you more money to keep the trade on. So you must roll out and up. Up closer to the strike price. It's down on the option chain. So you want to roll it up, let's say to the 150. So in that case, you would take in a credit of $3.10. Now, of course, the 150 here, 72 delta, not so bad. 249 on 1025, that's less than 30%. That's actually pretty solid. You could roll from the 145 to the 150s, take in $3 of credit, gives you an additional week to see if it's going to work out. Gives you an additional week until your exit signals come through, and it reduces your gamma risk. Gamma risk is scary. That is what I want to avoid at all costs. What is gamma risk? So here's the deal. By now, you probably understand that I know my shit. By now, you probably understand that Chris is an actual professional investor, and this is what he does for a living, right? I'm not one of these vampires or anyone else on the internet who claims to be a trader. I know my shit backwards, sideways, upside down, inside out, with both hands tied behind my back, blindfolded, okay? Do me a favor and share this with somebody who you think would benefit. And let's talk about gamma risk. Gamma risk is scary. So for example, let's say we own the 150 strike, right? The 150 strike, if price goes down $7 today, would be out of the money. I'm just saying hypothetical. If it goes down $7 today, it's out of the money. It's worth nothing, absolutely nothing at all. And that happened all in a single day. However, if I am holding the October 14th 150s and it goes down $7 today, yeah, that sucks. I'm losing money, but my option still has value. And I still have time, so therefore I will still have both intrinsic and extrinsic value. My extrinsic value is probably going to explode, by the way, because we're getting closer to the money. But my intrinsic value, how deep it is in the money, will go down. So in this case, I would have significantly less gamma risk because I have more time on my side. But here, gamma risk is off the charts, right? This is like the Hulk walking into it's like the Hulk if you walked into a room full of radioactive spiders. There is gamma risk all over the place, right? And yeah, you don't want to be in that room. That's a scary room to be in. And I certainly wouldn't be there, even with your money. So listen, if you're ready to save time, make money, and start winning with less risk, you should probably click one of these two videos. We'll talk soon.